everyone who showed up today. And just wanted to let you know who's on our call. We have Aaron Johnson with First Home Mortgage, who is one of our home buyer seminar regulars. And today we have Matt Dillingham from A1 Solutions Credit Repair. So we also have Tia Thompson and Vonley Jackson and Janelle McElwain from the McElwain Group. And I'm Dawn Ferguson. So just wanted kind of some housekeeping things. If you have any questions or anything, you can either put it in the chat or either just unmute yourself and ask the question. We're here to answer all your questions. So what we wanted to start out today, we wanted to talk about the realtor's role in purchasing your home. Very important. The realtor, number one, is going to help you, along with the lender, determine how much home you can afford. You know, we all want to look at these big, beautiful homes in the $600,000 range where you may only qualify for 250. So we do need to kind of narrow you in and see what you can afford. And then just because you can afford a higher amount doesn't mean that that's what you want to spend. So we're going to help you determine that. We are still going to help you know your financing options. We're going to assist you through MLS in finding your home. We will actually put in your wants and needs, and you'll actually get the list each week, or actually you'll get lists as soon as the homes become available that fit your criteria that we can go out and take a look at. We want you to understand documents that you get with homeowners associations with front foot fees. There are a lot of documents and a lot of things that have to be organized that your realtor will help you with. We will coordinate lenders, appraisals, inspections. You need to know what kind of inspections to get, or we'll advise you about that. We'll talk about earnest money deposits, escrow accounts, closing costs. We'll assist you in your final walkthroughs. We will coordinate with negotiating your deal. Once you found a house, it needs to be negotiated with the other agent. We're going to work with the seller's agent and just to make sure you have a smooth transaction. So having a realtor doing this process is very, very important to make sure you get the most for your money, and that you get what it is you're looking for in your new home. Anybody want to add anything to that?
I would say also, just to kind of really sum up what you just said, Dawn. I'm going to call you Aaron. I don't know why I'm going to call you Aaron. Is that, you know, the realtor helps take care of a lot of the behind the scenes types of interactions and documentation and conversations with your lenders, with the other agents, and there's a whole lot of things that go on behind the scenes that really your realtors are taking care of that for you. And that's the peace of mind that you have when you use a realtor, is that they're taking care of all that kind of minutia for you. As Dawn mentioned, if you were to even try to understand some of these documents and pull these documents together to make an offer or to list your home, it could be daunting and a little overwhelming. So we take on that for you. And we also make sure, like Dawn said, is to make sure that that process remains as smooth as possible for you. So we want to take some of that pressure, some of that stress, and probably some of the headaches of the process. We take that on for you to make sure that everything moves along in the most easiest process and that you could have. We want you to have a good home buying experience, and for those who are selling, we want them to have a good experience when they're selling that home.
Absolutely. And you want to make sure that the home that you're purchasing, we actually do run the comparative market analysis on the home that you're purchasing. Just because the home is listed for $350 does not mean that it's supported, that house should sell for $350. So we need to run those numbers. You need to have the access to the software that we have access to make sure that we're able to pull the comparatives and make sure that this is a home that's worth what you want to pay for it. You just don't throw a number out there. So like Tia said, there are a bunch of things that happen in the background to make your situation, to make your home buying experience go smoothly.
And our biggest thing is, as your realtor, we just seek to educate you about the home buying process. We seek to educate you about the lending process. You may have questions about credit. You may have questions about the inspection process and every process moving forward. So our job today and every day is to educate you through the process to make sure that you are making the right decision, the decision that best benefits you and your loved ones, everyone who will be involved in the transaction, to hold your hand and walk you through this process from start to finish, making sure that we reach our goal. So that is what we're doing here today. So we have the lovely Erin Johnson with First Home Mortgage. We have all fabulous ladies of the Wayne Group and Madam A1 Solutions Group here to educate you through your process. Thank you for joining us.
Am I going now?
It is on that.
Okay. I wasn't sure for a second there. I was like, all right, cool. Yeah, I was like, okay, cool. Hi, everybody. Good morning. How's everyone's Saturday morning going for you? Thank you for joining us. I'm here to talk to you all about the most exciting topic of all time that whenever I talk about it, people get like, yes, I'm ready for it. It's credit. Said no one ever in human history. You want to challenge me on it? Don't worry. I'll wait. Okay. But anyways, but let's get serious on it. So what I'm going to go over is a topic that's very important. It's something that is it's not very understood. It's not taught. Unfortunately, people learn about it through the hard way. So I'm going to go over a little bit about the history of credit and really, I guess, take a deep dive-ish into it. And when you come out of it, you're going to know how this thing works inside and out, and also ask you questions along the way. And what I need to be able to do is share my screen. Someone can allow me to do that real quick so I can do my little slideshow. All right.
And while he's doing that transition, Latasha, I hope it's not saying your name right. Welcome. So we are so happy to see you. I think you may be using the audio portion, but that's perfectly fine. And welcome to the home buying seminar this morning. We're glad to have you, excited to have you.
Cool. All right. Can everyone see my screen?
Yep, absolutely.
Oh, no, I don't want to do that. That's the wrong button. Done. Slideshow. All right. Okay, so this is the game of credit because it is a game. You get points for it, but most people don't understand the rules. So let's get into it, shall we? All right, pop quiz, everybody. First question, how old is credit? Is it A, 5,000 years old, B, 70, or C, about 100 to 150 years old? So put your answers in the chat or feel free to shout it out. The more participation we have, the better. Which one is it? Is it A, B, or C? And don't worry, I won't judge you for any answers you give. I got one for A. Anyone else? B, C. All right, 3, 2, 1. The answer is A. Credit is old. It's very old. It's just as old as insurance. It's not a modern invention. It's been around for at least 5,000 years. So the time of this, we got summer, 3,500 BC. It's the first urban civilization with about 89% of its population living in cities, okay? And it's thought that consumer loans for agricultural purposes are first used here. Babylon, 1800 BC, the Code of Hammurabi is written, which formalizes the first known laws around credit. It also establishes, excuse me, the maximum interest rates that can be used legally. So for grain, the most you can charge on that interest-wise is 33.3% per year. And for silver, it's 20% per year, which is kind of high. But to be valid, the loans have to be witnessed by a public official and recorded as a contract. Okay. So Roman Republic, 50 BC, around this time, Cicero notes that his neighbor bought 625 acres of land for 11.5 million sesterces, if I'm saying that correctly. So they literally carry, 11.5 tons of coins through Rome. They did not. It was done through credit and paper. I'm not going to try to read the Italian word for it, the phrase, but translation it reads, he uses credit to complete the purchase. Dark Ages. 800 AD, after collapse of the Western Roman Empire, economic activity grinds to a halt. The church bans usury, which is the practice of charging interest on loans for all laymen under Charlemagne's rule, 768 14 AD. So land expect nothing in return. All right, spoiler alert, you can see how England shapes where we are today in this. So the age of discovery, as European explorers and merchants begin trade missions to faraway lands, the need for capital increases. England in 1545, okay, after the Reformation, the first country to establish a legal rate of interest is England during 1545, during the reign of Henry VIII. The rate is set at 10%. England, 1787, philosopher Jeremy Bentham writes a treatise called A Defense of Usury, arguing that restrictions on interest rates harm the ability to raise capital for innovation. Some argument there. If risky new adventures cannot be funded, then growth becomes limited. England, 1803. All right. Credit reporting itself originated in England in the early 19th century. A group of English tailors come together to swap information about customers who fail to settle their debts. It's the earliest available account of credit reporting. Now get this. England, 1826. The Manchester Garden Society is formed and later begins issuing a monthly newsletter with information about people who fail to pay their debts. So compare this to now, where credit's very personal. No one else sees it except for you, who you share it with. Back then, they didn't care. They were like, if I came to Vanley and was like, hey, can I borrow $100,000? She could look me up in this paper and go, Matt didn't pay one back. Forget that today. They didn't care back then. They put your business out there, which is England for you. All right, Atlanta, 1899. So the retail credit companies founded begins compiling an extensive list of creditworthy customers. This company later changed its name to Equifax, which, as you know, is infamous for its hacking scandal, and the latest one that happened back early this year when the scores were jacked up. Yeah, that happened in case you know about that. Equifax is the oldest of the three major credit agencies in the United States. 1955 in the United States, early credit reporters used millions of index cards stored in a massive filing system to keep track of consumers around the country. To get the latest information, agencies would look through local newspapers for notices of arrests, promotions, marriages, and deaths, and attaching this information to individual credit profiles. And unfortunately, they leaned heavy more on the negative stuff about people than like the good things. 1964, the Association of Credit Bureaus in the U.S. conducts the first studies into the application of computer technologies to credit reporting. Accuracy of data is improved around this time by standardizing credit application forms. All right, it's a little bit of credit. So here's truth by credit. You can dispute anything in credit report. It doesn't matter if the item is yours or not, even if you owe the debt or not. You have the right to do so by the Fair Credit Reporting Act. And also because the onus of the reporting is not on you or I. It is on the bureaus, creditors, and debt collectors. And if they jack something up, they are liable for it and can be sued for a lot of money. Okay, so pop quiz number 2. What are the 4 tiers to your credit report? Anyone have any clue on this? No, I'm gonna ask the question again before an answer. What are the 4 tiers to your credit report? This one always gets people. It's kind of funny. All right.
I think you have us stumped.
Yep.
Yeah.
All right.
Auto, business, personal, and what? And insurance, maybe?
Say it again.
There's personal, there's business, there's auto, and then maybe insurance. Maybe I was guessing.
I mean, personal is part of it, but the rest not so much. But here we go. So you have personal information, hard inquiries, accounts of public record. These are the 4 tiers to your credit report. And remember this from now on, because when people pull your credit report, they're seeing all 4 tiers. Unfortunately, people focus on the accounts. And when you do that, you're focusing on only 1/4 of your file. All right. Next question. So as you all know, it's programmed into 4 different tiers, right? So out of these 4 tiers, which is the one that you want to make sure is the most up to date?
Personal information.
I got 1 for personal information.
All of them.
I got 1 for all of them.
I would
One
agree
more.
with personal information.
2 for personal, 1 for all. Anyone else? Last one? Okay. The answer, personal information. Okay. So this section is going to contain your name, variations, if you were married before, your birthday, your social, current address, old addresses, any employers, all that. This is important to know because in that section, if you have to repair your credit, anything in the section is old, outdated, erroneous, or attached to negative items in your file. So what happens is with the credit bureaus, if you're just being an accountant with them, they'll look to see, because they're lazy, what name and address that account's attached to. And here's the thing. I've had clients look at this section and they've had on their names, addresses that aren't theirs, that they've never lived at. Also, too, fun fact is that if your name is misspelled by just one letter on your credit report, it makes everything else attached to it fraud by law. Okay. The other thing too with ladies, if you're married or have been married, that means your married name's still on there or the maiden name's still on there. That makes you right for fraud. That means someone can take that information, apply for credit in your maiden name or old married name, and get away with it. Okay. So what we have our clients do is call into the bureau to get the section updated. And just by doing this one part, it can help boost their scores anywhere between 20 to 70 points by itself. I've done it. Clients have done it. It's very something you want to do. It's a nice little hack. The other thing too is that when you don't update a section, if you just have a whole bunch of addresses and names, it kind of makes you look shady and things like that. So people do look into this to see where you've been, and another fun fact too, as well, last thing on this slide, if you're applying for credit, if you put down a current address that does not match the current address that the bureau that they use to put your credits on, that's on file, you can be declined just because of that. It happened to a friend of mine last year. All right, hard inquiries too as well. You can call up the bureaus and remove hard inquiries that are not attached to any open accounts. You can do that. The FTC, you can say, look, the FTC allows them to do that. Now, one thing about the bureaus that when you call them up to remove hard inquiries or like your personal information, they know what you're trying to do. They will try to BS you, and they will say some bogus stuff like it can't be removed or whatever the case may be. So if that happens to you, hang up the phone and call back sometime later, because it comes down to the rep. I've had reps be really nice and do it right away. Others I've been right overseas told me I had to mail stuff in. You don't have to mail anything in. It's BS. They'll do it. Just call back another time and get somebody different. All right. So going to your credit score is something I would see back in the past and just go, all right, pay your bills on time, whatever. Here's how this breaks down. Everyone knows that paying your bills on time is everyone knows that part, but paying your bills on time is 35% of your score. That is the biggest chunk. The next part is amounts owed, which is really credit utilization. That is 30% of your score. What that means is if you have one credit card or several, you want to keep the balances below 30% of the credit limit, because you use too much, you go above that, you'll get dinged for that. It also looks at this overall and individually. So for example, if they're all at like a zero balance, you go above 30% of one card, you lose some points. If you go above 30% of all of them, you'll score will plummet. And credit cards are important, okay? They're not evil. They're just a tool to be used, because if all you have on your file are installment loans like student loans, a car note, personal loan, or mortgage, as long as you're paying it on time, you get points for it. Once it's paid off, it stops giving you out to score, and your score is going to stagnate. Credit cards are revolving debt that goes on forever, and you need that because that allows you to get into the 700s and 800s, because that leads into your length of credit history. The older your accounts are, the more points you get for that, and it looks at, and that 15% looks at the average of all your accounts. So the older your average age of credit history, the better. So if you have like an average age of like 7 years, you get more points than someone that's got an average age of only 3 years. Next chunk after that is credit mix, meaning you can have a mix of some revolving credit, like a car note or a mortgage. Forgetting something else here. You can also add on there utilities, rent, and cell phone payments too as well. A nice mix to show that, hey, I can handle this, I'm responsible. And last chunk is 10% is new credit. Any new accounts you get points for, and also having a low amount of hard inquiries, which do matter. They do matter. Places will look at your hard inquiries, how many accounts you have. If you have more hard inquiries than open accounts, that's a red flag. It goes against you.
Matt, I have
Okay,
a question.
so what's the difference between a hard inquiry and a soft inquiry then?
Okay.
Inquiry.
Okay. So a soft inquiry is when either you're looking at your credit. In some places, we'll do a soft pull. You're not going to lose points for it. A hard inquiry is when you go to, you're authorizing someone to pull your credit and you lose some points. I'm glad you brought that up. So the funny thing is this, when you get your credit pulled on a hard inquiry, if you get approved, you lose a couple points. But if you get declined, you actually lose more. It's really jacked up. Yeah, it's jacked up. So keep that in mind.
So Matt, question for you, because a lot of times when I see credit reports, I've seen someone who might have bought a vehicle.
Yeah.
And they'll go to the dealership, authorize the dealership to search for a loan, and then they begin shopping for them different institutions. And every time they shop, they have their credit pulled. And so when you talk about removing hard inquiries, let's say this person authorized one individual and they get approved through a bank, but they have 5 other banks that have now inquired on their credit report, which obviously is going to cause an issue.
Yep.
Can they remove the other banks, the accounts that inquired that they didn't take the loan through, and leave just the one? How does that work? Because if we're removing hard inquiries, obviously, if they don't have an account associated, those other 4 banks that may have approved them but they did not take a loan, is that eligible to be removed?
Yeah, you can have them all removed. So what it comes down to is, so for the ones that they didn't authorize, they do that because I got a new car last year and I was like, don't shotgun it, and they do it anyway. And I think the system knows that, like, in that case, you won't lose like a crap ton of points or anything, but still the ones that aren't associated, you can dispute that, right? And even if you have a hard inquiry with an account that's open over the phone, it's a weird caveat. They're like, no, you can't do that, but you can dispute in the mail, because if you didn't have a wet signature on there, whatever the case may be, you can still get it removed anyway. So yeah.
Okay.
Cool. Anything else? Yeah.
Well, I'm the disputing part of it from a mortgage standpoint, it gets really kind of dicey, because if you've disputed something and the dispute remains on your credit report but not finalized, we have to have it removed before we can.
Yeah. Because we tell our clients, like, if they're ready to go, we tell them, call into the bureaus. You can take out all your disputes this way. I don't know why that matters anyway, but I'm not an underwriter. It doesn't make any sense. But yeah, we tell them that, say, look, take it out. Then once you close on a loan and everything's finalized, you're in the house, then we can start back up again and then keep it going from there. So yeah, we're flexible with that. Does someone else have another question, or was that it before I move on? All right, cool. All right, bankruptcy. So people know about that. Fun fact about bankruptcies too. It was discharged, it stays on for 7 to 10 years, but it was been dismissed, it's an automatic 10. I don't know which is worse, but they're still jacked up rules anyway. They don't have to say in your credit report, because what people don't know is that, you go to the bankruptcy court, but the bankruptcy courts don't report to the bureau. So the question is, how do they get on there? The bureaus buy that information because it's public and then place in your credit profile. Is that okay? No, because what they're doing is they're playing both the credit bureaus and the furnisher of the item. You can't do that. That's not okay, and that's a loophole. So one of the things people can do is they can go online to LexisNexis, SafeStream, and Novus Data, which are sub bureaus, freeze your information and dispute it that way, because they do try and look into that stuff to, verify things on you. But that's a violation because they don't report to the bureau. The bankruptcy courts don't report to the bureau, so you shouldn't be on in the first place. But for some reason it is, because people don't know their laws or the rights in this case. So collection charge-offs. So collection charge-offs, when there's those you don't owe, particularly with collections. Now, some people think, okay, if I pay these, it'll help my credit. It doesn't. It does not help your score at all. It can drop it. Even if you do pay them, it remains on your file as a paid collection, pay a settled charge-off. And some companies are okay with that, but if you're trying to get like the high-level credit cards with the great perks and better stuff, and they see that on there, they think, okay, so you didn't care to pay this until it got that far, and then you did something with it, okay? The other thing too is when we have these paid charge-offs and paid collections, it weighs your score down. So if you're trying to bump up your score, it's weighted. So if a new lineman is supposed to give you like, 70-point boost in your score, you have these collections of charts on your file, you may only get like 15 or 20 points. Okay. The other thing to with collections is that you don't legally owe the debt. The creditor sold that along with your personal information to the debt collector. They bought it at pennies on a dollar. And the reason why, if you ever spoken to them, they have to get you to admit to everything because they don't have a contract. And for them to go and get it is a hassle. So they had to get you to say this over the phone, to record it. This way they have something used in court if they have to take you to court. Okay. The other thing too that I put on here is that collections to be on your file is illegal. And I don't know if anyone knows about this, but I don't know why they're taking their time with this, but all three bureaus have decided that for medical collections up to a certain point won't be reported on your credit report. I think it's up to like 500 or something like that. But they're like, well, they said we won't take it. This won't take into effect till like next year. And I'm like, why not do it right now? That makes no sense, but it's how they make their money. So yeah. COVID-19, this thing that we're still in that's taking forever. So before it started, bureaus could take up to 30 days to look into dispute. With COVID, they can still take up to 60 with their clients. I haven't seen it happen. It's rare. But just keep that in mind if they don't get back to you, because I don't know if they're back to being fully staffed or where the case may be. The bureaus keep a lot of things. They're not transparent. They tell you some stuff and keep a lot of stuff in the dark that only they know. Mm-hmm. So credit has gotten out of hand. Here's what I mean by that. And earlier in this presentation, health, life, car, and homeowners insurance, except for Maryland. Maryland stopped doing homeowners insurance, checking credit. They do all those other three. They'll check credit. Sometime last year, I was talking to a certified financial advisor, and he was telling me how he said clients that were declining life insurance because of their credit, and I didn't know that was a thing. Which is that shouldn't be a factor. It shouldn't be. It should be your health. Hospitals check your credit too. It's soft pull, and the reason why they do it is because people seem to forget that hospital is a business. Yes, there's people, nurses, and doctors that care, but the hospital has to make money. And they will do a soft pull even if you have health insurance, because the hospital is thinking, well, this person needs a procedure that's, let's say $50,000. They had no health insurance and the credit history is crap. Like, what are we going to do? Do we want to send collections and lose money on that? They do. They will look at that. I don't know how many do, but it is checked. Employers check your credit too. Particularly in the financial industries like insurance and in the government and higher level stuff. So you can be down a job, be denied a lateral move or a promotion, and even be fired for a bad credit. We had a client of ours who was working government, had a high security clearance, and they checked the credit, and the credit wasn't in good shape, and so they lost the security clearance along with the income with that as well. Okay, so for everyone watching this, having your credit in a good standing is more than just being able to get a home loan or rent an apartment. It's expanded to other stuff where you are pretty much denied things in life that you shouldn't be denied. And I don't make the rules. It's just how it is. So Credit Karma, let's talk about that real quick. All right. So Credit Karma, it only covers 2 out of 3 credit agencies. And if you're going to apply for something, no company is going to use it. It does not give you a FICO score. It gives you an advantage credit score. FICO scores are lower than Vantage scores. Vantage credit scores are 30, 50 points higher than FICO. In some cases, they can be 100 points higher. And it's only giving you so much. And they had a scandal recently, which I did some videos on, where they were giving people false pre-approvals, false approvals. And now they're ordered by the FTC to pay out $3 million to those who that happened to as well. Because when it comes to Credit Karma, it's free because they have so many people, they can charge money to people to advertise and have your data. So at the end of the day, when it comes to Credit Karma, you're the product. They're selling your stuff because they know your credit. And especially if you use their services for, I think they do with connecting your bank account, they know your spending habits too as well. You're a gold mine, and they're selling that to everybody. So I would throw Credit Karma in the trash, to be honest with you. All right, so real quick, going more into this, you do not have a real credit score. You can't. All you have on all 3 credit bureaus is your information that you want to make sure is clean and up to date. Vantage and FICO, different scoring models. In the United States, 9% of companies use FICO, 10% use Vantage. Then to further confuse you, the reason why your score is all over the place is because there's different scoring models within each. Vantage got 2, 3, 4.0. FICO has 2, 4, 5, 8, 9. I got to change this now to 2022. FICO 10 trending. Okay. So when you go to one company to another company, they come with different FICO scoring models, and that's why your scores may be different based on how it is and which bureau they pull and all that stuff. Okay. FICO 10T is very important. You need to pay attention because all the other scoring model updates, what happens is when you get your credit pull, they're seeing a snapshot where it is right now at this moment in time. They're not seeing where it was a couple months ago, 6 months or 6 months ago or a year. FICO 10T gives lenders way more information that I think they need to know, but they're lenders, they want to know your future behavior. FICO 10T is trending. That means it gives them a 2-year look back into your credit. They can see if you've been jacking their balances, paying them down, what you got deleted, what you're doing. So basically, keep it simple. If you have not been doing an upward trend in your credit, your score's been low. If your score has been bad or whatever, you'll get a lower score. And the jacked up thing is with FICO 10T is that you could have been getting credit up, let's say within a couple months to like a 700, go apply somewhere, right? And then they'll run your credit under FICO 10T and it comes back like a 500. You're like, what? Why is that? Because based on that scoring algorithm, that score they have versus everything else. So it just further confuses people. And like I said, at the end of the day, you want to make sure that your information on all 3 bureaus is up to date because they're all going to have different information. It's rare if it's going to be the same across the 3. If it is, it's only going to be the same for, only so much time. Did mention earlier, you can add utility cell phone payments, payments like Netflix to your credit report. Experian Boost will add Netflix, cell phone, utility payments. Self-Lender is an app is an app I've used and recommended my clients go to. They just came out with this now. They will add your rent and other stuff that's mentioned to as well. Like monthly fee of just under $7. There's an app called Perch, which is I'm still waiting to use. I have an Android. iPhone users can use it. They'll add some other stuff like streaming services, rents. You can also if you just want to add your rent, you can add rent. Actually, don't do rent reporters. They only add 2 bureaus. BoomPay uses all 3. And for anyone who wants some of the benefit of that, you want to show your rental history if it's positive, you've not been late. Because the jagged thing is the reason when they add these things because they all check your credit, but they don't report to it. Adding your rent is important because what they can do with the rental history, that's an age trade line. So basically, if you've been paying rent for 5 years, you can add 5 years of positive rental history to your credit, and that'll boost your score and make your credit report look better. And therefore, when you go apply for a home loan, they see, okay, you've been paying this on time for X amount of years. That's good. And they can also do ongoing, take advantage of that because rent's going up. They check your credit, then report to it, take advantage of it, and use that for your benefit. I highly, highly, highly recommend it if you're able to do it. And if you can do Experian Boost, you got Netflix, have it go on there too, because you're going to binge watch Netflix, now you can do that and say, I'm building my credit history at the same time, and no one can tell you anything because it's true. I've used it. Last one. So when do you stop building your credit? A, is it after age 65? B, you submit a special form to the bureaus at the age 72 that exempts you from needing credit as you retired, hopefully. Or is it C, never?
Never.
I got one for C. Anyone else? Yeah, C, it's correct. It's a lifetime thing. Unfortunately, we're not told that. I've had one client we're trying to work with. He's a veteran, 75, had bad credit, and was denied a loan through the VA. It's a lifetime thing that doesn't stop. And with that also being said, it is a marathon. If you're a person who has issues with your credit, keep this in mind. You did not get there overnight. All right. You also do not rebuild it overnight. And if you somehow are able to do it pretty quickly, again, it's a marathon. The trick after that is getting used to maintaining it. It's just like if you lost the weight before and you're good to go, you have to do it where it's sustainable to maintain it. So instead of having to, gain it back, losing it, gaining it back, losing it, it's not good for the body. Same thing with finances. You want to rebuild it, destroy it, rebuild, destroy it, you'll just give up. All right, last question. Should you co-sign?
No.
Well, the truth of the matter is, it isn't a right or wrong answer. I tell people, and you're right, to like, you shouldn't. If you decide to do so, you better have an agreement in place, written, or whatever the case may be. So this way, you or the persons are both under the understanding of how this works. Because the problem is, I do run into this, people have co-signed for something, and once that joint account or co-sign account is on your credit report, getting it off is pretty much impossible until it's closed by you paying it off, or it gets charged off, unfortunately. Cool. All right. And that's all I got, everybody. Thank you for listening.
Wow, there's some new things. That was fantastic. Fantastic. Any questions?
Yeah, any questions?
For Matt?
Told you.
And LaShawn, welcome. Go ahead. I'm sorry, Matt.
No, I was saying, told you, like, I kind of go deep with this. I want to make sure everyone understands this, like, from A to Z. So.
Fantastic. This is good stuff. LaShawn, welcome to the session. I see that you popped on. Latasha, any questions for Matt? Let me just double check the chat, because just in case I missed anything there. And honestly, speaking of the chat, if anyone feels more comfortable in asking their questions through the chat, make sure that you use that feature as well. All right, cool. Let me just double check. I think we're good there. All right, so we have, I guess, an old veteran here on our team, Miss Erin Johnson. And Erin is with First Home Mortgage. And I enjoy working with Erin because I love her little tidbits that she tends to send to me and probably to other clients about what's happening in the market, because it's really important that we understand that. And then it helps us as agents be able to better be able to communicate that to you as potential home buyers, and to get you to understand, what your options are. Now, I always say I like to stay in my lane. I focus on real estate and focus on, the ins and outs of real estate. But when it comes to lenders and mortgages, I leave those to those professionals who are licensed to do so. And with that, I'm going to transition this over to Ms. Erin to walk us through what's happening in the mortgage industry right now. Erin, it is all yours, my friend.
Thank you, Tia. So very happy to be here this morning. And definitely when it comes to mortgages in general, the more information you have, the better you are. Matt, I thought some of the information you gave today was awesome, because that's always our first step in the process, is prepping you credit-wise for what you're going to experience during a mortgage transaction. And I love the fact that you mentioned Credit Karma is not the way to, it is a great monitoring tool. I will not dispute that. I use it, but do not trust that score is what it's going to be. So, and that's all I have to say about that. As far as what's going on in the market, so we're challenged. I think some of the things that I think we should expect to see are ways to get people into homes with the challenging market. Perhaps we'll see some of those programs that we haven't used in quite a while reemerge as first-time homebuyer products and things like that. It's important when you go into this, because you hear a ton of news, and I love news broadcasters. They're so in the know, but they misguide often. Essentially, we've got two things that are happening right now. Yes, interest rates are going up. Property values are tough. There are two different things of that. I'm talking to people every day. We're going to wait till values come down. Honestly, guys, I don't think values are going to come down. We're in a different world in which we were in the 2008, 2009 market, which was that recession caused by the mortgage industry, caused by bad loans, wrong loans sold to the wrong people, things like that. So that property decrease or that decompression of those property values at the time that we saw that 2008, 2009 market decline, that's not happening right now. We've got really responsible lending happening. We have to look at the ability to repay. We are documenting income and assets. We are looking heavily at credit and past credit history. We have put together, or through the Dodd-Frank Act, put together a mortgage industry that's a little bit more stable when it comes to the products in which we're passing off to the consumers and educating them a little bit more on what the responsibility of a mortgage is. That being said, the interest rate situation. Interest rates are direct relation to inflation. Okay. I always say that inflation is the kryptonite, like Superman's kryptonite, to interest rates. If inflation is up, interest rates go up. Now we hear all the time that the Fed's fund rate is being adjusted. That's not your consumer rate. That is the rate at which banks borrow money overnight from other banks. Now, of course, it does have an impact on your rates because of the fact that now the banks are being charged a little bit more money to borrow money. Therefore, they're going to pass it off to you. Okay. But it's not necessarily when the Fed fund rate moves up or down, it does not mean that the mortgage rates are doing the same exact thing. So that's one thing to prepare for. Interest rates right now are in the 6s. That is a more normal market. The market of the past is not going to be seen for a while. Okay. Now there are solutions to those programs, to those things. If you're a little uncomfortable or you now are qualifying for a little less house and you're qualifying for, say, an FHA loan, a 2-1 buy down might be a solution. And you guys can correct me if I'm wrong on the realtor side, but we're starting to see things sit on the market a little bit longer. Therefore, we're moving into more of an even market. A couple months ago, you put a house on the market, 24 hours, it's gone. Okay. That's not necessarily happening right now. So 2 things are happening in that department. 1, houses are being priced more reasonable. And 2, there's less competition out there for those of you who have been waiting for a little while. And once we get you past the comfort zone with regards to payment and cash to close, then we can move forward and it might be time for you. I still think it's a fabulous time to buy in the market because, as I said, we're not necessarily going to see that depreciation or that decrease in interest rates. If you buy now, even if you're paying a little bit more monthly for that loan, you're appreciating an asset. And if you were to take the funds that you have right now that you would use for down payment and closing costs and put in the stock market, you're not going to get as great of return for now. Okay. Eventually that's true. There are 2 really good investments you can make in your lifetime. 1 is your 401k plan and 2 is buying a primary residence. 100% believe that and use that as your basis to building wealth. So that being said, can I answer anything about the state of the market? Does that all kind of make sense? Where we are, where we're going, that kind of thing? And all right, so as far as getting a home, the first step is always credit. Okay. I typically like to be the first person to talk to you about credit. I like to be involved in the repair process. And during that time, we may enlist the help of Matt and say, hey, Matt, we need your help with this one. I can't do it. He knows a lot more. If a lot of this involves, disputing accounts, going back and updating your personal information. Yes, we do look at your previous addresses. We look at your, your rental history in some cases. If you did add that to your credit report as a consumer credit to help build credit, that would be a huge win for me because it would take one question out of my process, and that is, do you pay your rent on time? Because for a mortgage company, we like to see that you like to keep your roof over your head. Okay, we don't want to own a home. We don't want to take your home. We want you to stay in there. All we want is to earn interest on the money you borrow. And that's what makes our world go round. That allows us to lend to more people. So anyways, the first step is always your credit. We're going to be looking at employment history next. We're going to be looking at how much money you make and the ability to repay a mortgage. We do that using debt to income ratios. There are 2 ratios within that process. One is a housing expense ratio. That is your total housing expense divided by your gross monthly income. And we look at gross before you pay your bills and before you pay your taxes. So we're looking at your total paycheck before Uncle Sam and the state of Maryland or the state of Virginia or whatever takes that money. Okay. So we don't necessarily live in your budget. So one of the other things that we may have a really good conversation about is how you're budgeting, where you're spending your money. And I encourage you now that most of the bank accounts that we have will show you what percentage of your deposits are going towards what expenses. So if you look at, I know my bank does a wheel and it shows me that I'm spending this much money on fast food. Well, if I know I'm spending that, now I have a 15-year-old kid, that is normal. He and I have had to have this discussion, but those are the places that you can kind of cut back and compress to be able to afford maybe a little bit more on your budget. And that's what I encourage you to do, is look at how much you're actually taking home in your paycheck, how much you're spending, what things you absolutely must spend money on. I call that a survival number. A survival number is anything that puts a roof over your head, keeps your credit current, and keeps the lights on. Okay. Netflix is not a survival number thing. Okay. Darn it. But that is, you know, a lot of people confuse that. So one of the things I tell you to do is really look at what your survival number is. Pay your bills or your debit, and cut out any, right now, especially with everything being so much more expensive, cut out those things you don't need. I've done this myself, going through my survival number, because, the way that I get my money is I am commissioned, and it doesn't necessarily, it's not consistent necessarily every single month. So I know I need to be a little bit more conscious about that. So look at what things you absolutely must have, just like when you're shopping for a house, the absolute must-haves. Okay. And the rest of the stuff, weed through and see if you can cut those expenses down a little bit so that you can increase what your savings may be to buy a home. You can apply money towards things you desperately want or need, and you're prepping a little bit better. But that'll give you a clearer picture with that survival number as far as what you might be able to afford in a home. So that's essentially what we're going to be looking at. All right. That's the other part of it. When we don't live in your paycheck, we live in your gross income. So we're developing those ratios, assuming the rest of the stuff that's left over after you fit within that ratio box is everything else that you pay. I do want to say something with regards to student loans right now. I know we have some exciting news possibly coming down the pipe, but I will tell you that not everybody is going to qualify. Okay. And if you are watching your student loans right now and they are in forbearance, it's going to be extremely important that when they come out of forbearance, you make sure you're on top of those and make that first payment. I have seen too many people come out of forbearance, miss the first payment, and end up 120 days past due. That's how they were reported on the credit report. Have you seen that, Matt?
No, I haven't seen that, but I didn't know they were like, okay, we're just gonna like punish you like that.
Oh, it's immediate. There's no 60, 90. It's right to 120 days past due.
Whew. Okay, good to know.
So, yeah. So that's a side note. Now, and that's important too. If student loans are in collection during this whole COVID time, we've had people that had their student loans that were in forbearance, or they may have gone into collection even before that all happened. The credit bureaus and the credit reporting agencies stopped reporting those collection accounts. And there may have been things called CAVERS alerts placed on anybody who had not paid their bills, which is an automatic alert on your credit report or on your Social Security number through the government that says that you cannot apply for another federally backed loan until you pay or resolve the issue. So watch those student loans. Okay. Anyway, that happened just recently. And
That's
if
good
you do that,
information.
what,
Yeah,
yes,
that's great information.
if you're not really on top of those things, then it can really come back to bite you later.
Got it.
So after we've looked at credit, after we've determined your income, now your employment history, we want at least 2 years of employment history. It does not necessarily have to be the same exact job. It can be in the same field. It can be that you went from a part-time job to a full-time job because you got your degree. It can be all of that stuff. And oh, by the way, if you have been in school and you finally got that job, you graduated, your school transcripts can actually justify a 2-year history of employment as long as you meet the minimum requirement as far as showing the income you're going to receive now. Now, if you're an hourly employee and you're just entering the workforce, and I know this happens a lot with first-time homebuyers, if you're an hourly employee, you need at least 6 months of employment out there, okay? And the reason is you're a variable employee, your income can fluctuate based on the number of hours, and we have to be able to develop a real average of your income. Now, if you are an hourly employee and your employer is willing to put in writing that they guarantee you will work 40 hours, and we have 30 days worth of pay stubs showing that you're working a full 40 hours, we can usually make a case for that. Because then technically you're full-time. But even if it's like 35 hours, you know, I know a lot of nurses out there, you get 35 hours. And if they're guaranteeing you that base of 35 hours and you just started in the nursing field, we can a lot of times use that. So income. When I go through this, I think of a mortgage as a chair. You have 4 legs. One of them can be a little wobbly, but everything else has to be really strong. If you have 2 wobbly legs, you will fall down, and that's not a good chair. Okay, so credit is 1, employment history is 2, income would be 3, and the assets or even the collateral would be the last one. Okay, now when we look at the debt to income ratios, we have clear guidelines that say you have to be this and this. But now that we utilize an automated underwriting system, which essentially looks at risk, it will evaluate as a whole and doesn't necessarily fit you right into that box. So you can exceed those ratios a little bit if you have some reserves. So that's your asset leg. Assets would be cash assets in retirement accounts, thrift savings plans, anything that is out there that have accumulated a balance that we might be able to use in the event you needed it to pull in and help with that mortgage payment. So those are your reserve accounts.
So I have a question for you, Erin.
Okay.
When you talk about that automated underwriting process, okay, let's say that the buyer, potential buyer gets approved, I guess, through that automated underwriting process. So at some point, I'm thinking that underwriters will do a little bit deeper dive. And at that point, it's a possibility that you can no longer be qualified for funding, even though the automated process has said, yeah, you look good right now.
So it's kind of a 9 times out of 10, the answer to that is no, that we would be able to follow through. Okay. And that is another good portion and really good point is the following. Those systems are garbage in, garbage out. Okay. You want to make sure that you are, we are very well versed in all of the systems that we use. One of the reasons we are so diligent up front, it used to be that within, 2 hours, we could turn around a pre-approval. And that is not necessarily the truth anymore. My team specifically, and I know a lot of really good loan officers from other companies that do the same thing. Before I will put my name on a pre-approval letter, there are certain things that are going to happen. Number 1, I'm going to have your pay stubs, your bank statements, your W-2s, your tax returns, your credit report, and anything else that I think could be an issue on your loan. So we're going to have a nice conversation about all the things that you have supplied to us. And I'm going to try to answer as many questions as I can within those documentation. And then I'm going to take that information and I'm going to input it into the system and I'm going to send it through this automated underwriting system. Now that automated underwriting system is going to come back with findings. And it may say to me, This is approve eligible, meaning I like the credit and it's eligible for purchase from one of these I say investors, but it's Fannie Mae, Freddie Mac, HUD, USDA, VA. Okay. Eligible for purchase or backing by any of those company or entities. Okay. And then I'm going to put all that together. We're going to look through the bank statements because the system can't look through the bank statements. We're going to be looking for any on deposits. We're going to be looking for funds that were not associated with a paycheck. We're going to be asking you to document where that money might have come from. And then we're going to send everything that we've collected to the underwriter. Now, the underwriter's job is really just to validate that the information I put in the system matches the automated system, and that we've answered any weird questions like where the money came from in your checking account that was deposited by Zelle on the 20th of August. Okay. The $100. And believe it, they look that low sometimes, depending on the loan. All right. So they're going to validate those findings. And as long as they see that I've been responsible from the very beginning and I've input that stuff, if they have additional questions, they'll come back with something called a conditional approval. They'll say, hey, we like everything that we see so far, but I have a question on this, this, and this. And that's when you'll get an email from a processor that says, hey, everything looks good on your file. We've got conditional approval. That is your, but we need to answer some questions for the underwriters in order to proceed. It's never over until it's over. I will say that. Okay. Now, I will tell you, always compare the process of a loan. When you're in school, you're looking for an A from your professor. Your underwriter is your professor. Your pre-approval is your outline. This is everything that we're going to do to get you into this house, your outline. Your initial submission into underwriting is your initial process is gathering and building that story. So, I always hand it in papers and I'd write these 3 sentence paragraphs and my teacher would come back and say, elaborate. Love that word, elaborate a little bit. So anyway, so we would then build that from there. So the processor is doing that, and then she submits it for her initial submission, and that is her rough draft to the underwriter. And then the underwriter is then going to review it and send back any questions. So you have a chance to get that A on the paper from the underwriter or approval. So it's a process just like that. And underwriters you'll never talk to. I cannot stress enough that any questions that you have, even if you think it's going to be a problem, your loan officer needs to know about it. Okay. Because I am presenting the story.
Right.
And there may be parts of your story I don't want to share. Or there might be parts of your story that can be cleaned up a little bit and just polished. It looks so much prettier, rather than having it come in on the back end. When it's already, you can't unsee it.
Yep.
I'll give you a prime example. I had a gentleman who was applying for a loan. He was getting a gift. He had $10,000 appear in his account. He wrote his earnest money deposit from the $10,000. I know that he's a commissioned employee on one side and that he was paid under the table for a second job that he was doing, but I can't use that. But this $10,000 was cash that he accumulated probably in a jar in his home. So he knew he was going to go write a contract on a house. He deposited the $10,000 into his account. 3 days later, he wrote a check out of that account for the $10,000 earnest money deposit. Well, we couldn't document that. And underwriters don't like cash. We don't like cash. We're credit people. Okay. Yeah. So we had to go back and figure out where that was. So we ended up, luckily had another family member who had $10,000 in their account that didn't just appear. And they were able to give a gift, but we had to remove the earnest money deposit from the contract. Now that gets a little shady, Well, not shady, but a little dicey, because your earnest money deposit, guys, just so you know, when you do write a contract on the house, you might be doing a 0 down program, but you're going to need some money up front to make sure that you are paying your earnest money deposit and for your inspections. Okay. Your earnest money deposit is the first glimpse into your financial situation by that seller who says, we're going to accept your contract. You've given us a deposit in good faith that you're going to follow through with this transaction. And in the event you fail to perform, not that you fail to perform, you just stop working on your loan or the purchase of the house and you decide to back out, that's not an okay reason to get your earnest money deposit back. But if something goes wrong with an inspection, you can't get approved for the loan, or you can't come to terms on something that happens during the transaction, which your realtor is diligently working to resolve, that that's your money that you'll get back and you can apply to the next purchase, or it gets credited to you at settlement. So a seller doesn't like to hear the words, we need to remove the earnest money deposit from the contract because we can't document it.
Wow.
Okay, so just so you know, that's how it works.